You know, um, usually when we think about a massive technological leap, we picture this like totally frictionless future.
Right, yeah.
We imagine strapping a literal rocket engine to a car,
Mm.
hitting the gas, and just watching it blur past everything else on a perfectly smooth, endless highway.
Yeah, it's an appealing mental image. I mean, we love the idea of unconstrained velocity, especially when it comes to technology.
Oh, absolutely.
We like to imagine progress as a straight line pointing directly up and to the right.
Right. But then you actually look out the window and you realize that rocket-powered car is, well, it's trying to drive through a swamp.
Yeah.
The engine is roaring, it's glowing red hot with all this incredible power, but the tires are just sinking into thick, heavy mud.
And the harder you hit the gas, the deeper the tires dig in.
Exactly.
That visual really captures the macroeconomic reality we're looking at right now. It is pretty much the definition of a market caught in a massive grinding tug of war.
Welcome to the deep dive. We are so thrilled to have you with us today.
Glad to be here.
Our mission today is to decode exactly what is driving the United States stock market right now. We want to move past those daily red and green arrows flashing on your screen and understand the hidden gears that are actually turning your portfolio.
It's so important to look under the hood.
Right. And to do that, we're looking at a huge stack of data we pulled from Trading Economics for May 2026, which includes market data, historical charts, and global financial news.
And to really understand this tug of war, we first have to establish the baseline of where we are standing today, which is May 18th, 2026.
Okay, beard it.
If we look at the main stock market index in the U.S., the U.S. 500, it is currently sitting at roughly 396 points.
So just under 7,400.
Right. Now, it fell slightly, about 0.17% from the previous session, but here's the critical context we need to keep in mind for you guys listening. The market is still up a staggering 24.01% compared to this exact time last year.
Wow.
Yeah, and in fact, earlier this month, the index hit an all-time high of 7 times 17.12.
A 24% gain in a single year.
Right.
I mean, that is the rocket engine I'm talking about.
Right.
And we all know what fuel is powering that engine right now,
Yeah.
right? It's the massive speculative rally in AI infrastructure. But I have to push back here a little bit.
Okay, go for it.
I'm looking at the futures, pulling back contracts for the S&P 500, the Nasdaq, the Dow, we're all trading lower.
Yeah.
But if this AI engine is so powerful, why are futures pulling back?
That is the million-dollar question.
Right. Like, are we looking at a fragile tech bubble if everything is just hanging on one sector?
Well, what's fascinating here is that the underlying infrastructure is booming, but the broader ecosystem isn't a monolith.
Okay.
What the data from Trading Economics shows is a really clear divergence between the companies building the AI infrastructure and the companies actually trying to deploy it and, make money off of it.
I see.
The market is finally starting to treat those as two very different business models.
Okay, so you're talking about the folks selling the picks and shovels versus the folks actually trying to find the gold.
That's a great way to look at it. If we look at the gold miners in this scenario, the AI hyperscalers like Meta, Alphabet, and Tesla,
The ones deploying the AI at scale.
right, consumer and enterprise scale, they are actually stumbling right now. The source data notes that because of their highly speculative nature, these hyperscalers track broader market risk sentiment very closely.
And right now, that sentiment is a bit shaky.
Very shaky. We are seeing Tesla, Meta, and Alphabet all down around 1% pre-market. Alphabet, for instance, has slipped down near $396 a share.
So the companies that are supposed to be like revolutionizing our daily lives with AI, the ones building the actual applications, they are blinking red.
They are, but then you look at the infrastructure side, the companies building those picks and shovels, the physical chips and the hardware.
Right, the Nvidia side of things.
Yeah, exactly. It's a mixed bag, but one massive outlier is holding up the entire narrative. Nvidia is trading higher, single-handedly holding the market's attention ahead of their Wednesday earnings report.
Oh, right, the Wednesday report.
Yeah. Meanwhile, other infrastructure plays like AMD and Broadcom are actually trading lower.
Wait, really?
Yeah, the data shows them lower, with everyone just laser focused on Nvidia.
It's like the entire market is holding its collective breath, just waiting for this one specific earnings report on Wednesday to validate the entire 24% yearly gain.
Pretty much.
But help me connect this for the listener. If Nvidia is doing great, why does a 1% drop in Meta or Alphabet matter so much to the overall market health?
Well, it matters because Nvidia doesn't sell chips to you and me.
Right.
They sell chips to Meta and Alphabet. If a 24% year-over-year gain for the broader market sounds like a rising tide lifting all boats, the reality is it's much more precarious.
It's concentrated.
Highly concentrated. It is heavily dependent on whether Nvidia can continue to prove that the demand for their hardware justifies their valuation.
Okay.
But think about the next step in that chain. If Meta and Alphabet aren't figuring out how to turn a massive profit on the AI applications they're building,
Then eventually they stop buying.
exactly. Eventually, they are going to stop buying billions of dollars worth of chips from Nvidia.
Ah, okay. The gold miners only keep buying shovels if they're actually finding gold.
Yes.
If they stop, the shovel manufacturer is suddenly in a whole lot of trouble. If that one pillar wobbles, the broader index feels it immediately.
And that vulnerability is why the market is so sensitive right now. I mean, it is priced for perfection in a world that is far from perfect.
Which brings us back to the mud that our rocket car is stuck in.
The heavy mud.
If the AI engine is sputtering a bit because the hyperscalers are nervous, what's causing that broader drag? Like, let's look at the actual physical world for a second.
The physical world is exerting a massive amount of gravity right now.
Yeah. Looking at the geopolitical updates we have from Trading Economics, we're seeing a major standoff in the Middle East.
Right.
The sources report that President Donald Trump has warned that Tehran is running out of time to reach a deal with Washington. And, at the same time, Iranian media reports are indicating that negotiations remain far apart.
It's a real gridlock.
And just to be clear for you listening, we aren't taking any kind of political stance here on the diplomacy. That's not what this is about.
No, absolutely not.
We are looking strictly at how this stalemate creates a very real expectation of a prolonged suspension in energy exports out of the Middle East and how that directly translates to your investments.
And the immediate translation is playing out in the commodities market as we speak. We are seeing Brent crude oil spiking up.
Right, it's near $102 a barrel.
Yeah.
And everyday gasoline prices are rising right alongside it.
Exactly.
But wait, here's where it gets really interesting to me. I've always struggled with this one connection.
What's that?
I get why a trucking company's stock drops when diesel goes up, obviously. But how exactly does an oil standoff in the Middle East immediately tank the stock of a tech company like Alphabet or Meta that doesn't manufacture physical goods?
A great question.
I mean, these are companies that live entirely in the cloud. Why do their stocks drop when a barrel of oil gets more expensive?
It really comes down to understanding the everyday consumer's wallet as a finite pie.
Okay.
Let's trace the transmission mechanism here. When you have a prolonged suspension in Middle East energy exports, global oil prices spike.
Right, up to 102 a barrel.
Right, and that creates a broad energy price shock. It costs more to transport goods, it costs more to power factories, and most importantly for this scenario, it costs you more to fill up your gas tank and heat your home.
So the baseline cost of just existing goes up for the average person.
Precisely. And when the cost of basic existence goes up, discretionary income,
Right.
the slice of the pie left over for everything else, it just shrinks.
Yeah.
So while Alphabet and Meta don't manufacture physical goods that require diesel trucks, their revenue models rely almost entirely on advertising.
Right, digital ads.
And who pays for those ads? Companies trying to sell discretionary things to consumers.
Whoa, wow. Okay, I see where this is going.
Yeah, if consumers are suddenly spending a significantly larger portion of their paycheck just to cover gasoline and groceries, they aren't, clicking on Instagram ads to buy new shoes or downloading premium software.
Right, they are closing their wallets.
Exactly. The advertisers, the shoe companies, the software developers, they look at their internal metrics, realize consumers are tapped out, and they pull back their ad spend.
Wow.
That drop in ad revenue directly hits the bottom line of the digital hyperscalers.
It's a massive chain reaction.
Yeah.
The mud slows down the entire economy, not just the physical supply chains.
Exactly.
The digital cloud is entirely reliant on the physical wallet of the average consumer.
That is the essential link. And it's why the market is currently so anxious to look under the hood of the U.S. consumer.
Right.
The sources highlight that investors are closely watching the upcoming earnings reports from major retailers.
Right, places like Walmart and Target.
Yes. In fact, Walmart stock is currently hovering around $131.45 a share.
So Walmart is essentially the check engine light for the American consumer's wallet.
That is a perfect analogy, yes.
If Walmart reports that consumers are trading down, meaning they are buying score brand items instead of name brands, or they are skipping the electronics aisle entirely and just focusing strictly on groceries because of this Middle East energy shock.
Then it confirms the market's worst fears.
It proves the energy shock is actively draining the consumer demand that props up the digital ad economy.
Exactly.
Okay, so if that check engine light is flashing bright red, who is supposed to fix it? Normally, we'd look to the Federal Reserve.
We would.
But looking at the macroeconomic data in our sources, it seems like their hands are completely tied right now.
The Federal Reserve is arguably the most important gear in this entire machine, and right now that gear is totally jammed.
Let's lay out the hard data here, because these numbers paint a really complex picture for anyone hoping for relief.
Let's do it.
Right now, based on the training economics data, U.S. inflation is stubbornly sitting at 3.80%. The Fed funds interest rate is at 3.75%. Unemployment is historically low at 4.38%. And on top of all that, the U.S. 10-year Treasury yield just hit a 16-month high.
Yeah, those inflation numbers are incredibly sticky, meaning they are resisting all attempts to bring them down.
So help me synthesize this, because we have a massive contradiction here.
Yeah.
We have an incoming Fed chairman, Warsh, and the sources note he has a historical preference for lower interest rates.
He does.
It's like the market was just salivating for cheap money to keep this tech rally going, to pump more fuel into the rocket engine. But this inflation data says his hands are completely tied. He can't cut rates without risking hyperinflation.
And the bond market is reacting to that exact dilemma.
Okay.
This brings us back to that 10-year Treasury yield hitting a 16-month high. Think about it this way. If inflation is running at 3.8%, almost 4%, and a government bond only pays you 3% in interest.
You are actually losing money.
Exactly. You are losing purchasing power every year you hold that bond. You are effectively paying the government for the privilege of holding your money.
Which no investor's going to do.
Right. So investors rebel. They refuse to buy the bonds unless the interest rate the bond pays is raised to beat that near 4% inflation. So the yields go up.
Okay, I understand why the yields go. That makes sense. But why does a high bond yield create such a massive drag on the stock market? Why does it pull the U.S. 500 down?
Because it completely changes the risk calculus for every investor on Wall Street.
How so?
Suddenly, investors have a choice. Why take a massive risk on a highly speculative AI tech stock that might drop 10% in a week when you can get a guaranteed, relatively high return from a risk-free U.S. government bond?
Oh, right.
It literally pulls capital out of the stock market and parks it in bonds.
It's like gravity. The heavier the bond yield, the harder it pulls money out of the sky and back down to Earth.
That's exactly it. And that gravity crushes certain sectors much faster than others, particularly companies that rely on heavy capital investment to build things in the physical world.
Which perfectly explains another massive data point in our sources.
Yep.
The Dow Jones plunged 537 points, or about 1.07% just on Friday. And it was led by massive drops in companies like Boeing and Caterpillar.
Heavy industry.
Right. But let's dig into the why there. Why are those specific companies so allergic to high interest rates?
Well, think about the mechanics of building an airplane or a massive mining excavator.
Okay.
Boeing doesn't just pay cash for the raw aluminum, the specialized labor, the factory overhead, and, the 10 years of research and development, hoping to eventually recoup it all when an airline buys the finished jet.
Right. They don't have that much cash just sitting around.
Exactly. They finance that massive production cycle. They borrow billions of dollars to build the machines.
And the airlines borrow billions of dollars to buy them.
Spot on. The entire heavy industry life cycle runs on debt. So if the interest rate on that debt jumps up because the Fed is fighting inflation, the profit margin on a 10-year manufacturing project can be completely wiped out before the first piece of metal is even cut.
Wow.
The business model simply becomes too expensive to operate.
That is fascinating. So, if I'm tracking this right, a geopolitical standoff in the Middle East raises the price of oil?
Yes.
That oil spike keeps inflation sticky at 3.8%.
Correct.
That sticky inflation forces bond yield up to a 16-month high.
Yep.
And those high yields make it too expensive for a company like Boeing to finance a new airplane, causing their stock to just plunge.
It is a totally interconnected web. And because recent economic data shows that U.S. inflation is actually accelerating, traders have been forced to face a really harsh reality.
What's that?
The source notes that traders have now fully ruled out any Federal Reserve rate cuts this year.
Zero cuts.
Zero. The expectation of relief is just gone.
The market had priced in this hope that Warsh would come in, lower rates, and save the day. And now they're waking up to the fact that he literally can't.
He can't. The Fed is essentially forced to maintain their rates in what the sources call restrictive territory for the foreseeable future.
Yeah.
They have to keep the brakes on the economy to fight the inflation being driven by this geopolitical energy shock, even though the chairman would likely prefer to be lowering them. It is just a complete macroeconomic bind.
Man. Okay, let's bring this all together because we've covered a massive amount of ground here today.
We definitely have.
For you listening, trying to make sense of your portfolio in May of 2026, here's the current reality. We have this incredible 24% yearly gain in the U.S. 500, but that gain is currently trapped in a brutal tug of war.
Very brutal.
On one side, you have the sheer, unbridled optimism of the AI infrastructure boom. Everyone is just holding their breath for Nvidia's earnings to justify these massive hardware investments.
And on the other side, pulling back with immense force, you have the heavy gravity of the physical world.
Right.
You have a Middle East energy stalemate threatening to choke off supply and drive up oil prices. You have that shrinking consumer wallet flashing warning signs at places like Walmart.
The check engine light?
Exactly.
Yeah.
You have rising bond yields pulling investment capital away from riskier tech stocks. And, you have sticky 3.8% inflation that is forcing the Federal Reserve to keep borrowing costs restrictively high, which completely rules out the rate cuts the market was banking on.
It is such a wild dynamic. We spend so much time talking about the cloud and artificial intelligence and these vast frictionless digital networks.
Yeah.
But at the end of the day, it all comes back to the physical world.
It really does. That is the ultimate takeaway from all this source data. It proves that no matter how futuristic our technology gets, no matter how advanced the AI hyperscalers become at generating code or writing algorithms, our financial markets are deeply, inextricably tethered to physical realities.
Yeah.
They are tethered to shipping lanes, to the literal cost of a barrel of oil, to the price of a gallon of milk, and to the interest rate on a factory loan. The digital economy sits entirely on top of the physical economy. If the physical economy experiences an earthquake, the digital economy is going to feel every single tremor.
Which brings me to a final thought I want to leave you with. Pulling from one last piece of data in our sources.
Okay.
We mentioned earlier that the U.S. 500 is sitting at roughly 730,396 points today. But the trading economics, global macro models, and analyst expectations are looking ahead.
They are.
And their models estimate that the index will actually drop to about 730.64 in 12 months' time.
That is a very significant projected contraction. It implies the mud is going to win the tug of war.
Right. So here is the question for you to ponder.
Yeah.
If the tech sector is currently priced for absolute perfection, relying on this AI engine to carry the entire market higher and higher,
Yeah.
what happens to that rocket-powered car if this geopolitical energy shock isn't just a temporary patch of mud? What happens if high oil prices, 16-month high bond yields, and restrictive Fed rates aren't just a blip, but are actually the new normal for the next year?
It's a sobering thought.
The engine might be incredibly powerful, but you have to ask yourself how your own portfolio is positioned if the parking brake never actually gets released.